Wow, this is absolutely crazy. If you've been watching the stock markets lately, you know for a fact that this company has been on an unstoppable, historic tear. We're looking at a pharmaceutical giant that is literally knocking right on the door of a $1 trillion market capitalization. Okay, let's dive straight into this explainer and tackle the burning question on every single stock watcher's mind right now. Is Eli Lilly's massive sky-high valuation actually justified by the raw data? Or are we potentially looking at one of the biggest healthcare bubbles in modern investing history? As investors, we absolutely cannot just buy into the hype blindly. We have to ask the hard questions. So I have our chief investment analyst here to walk us through the reality of the situation.
Thank you. If you look at the data here, there are three real fundamental causes hidden right behind these flashy news headlines driving this valuation. First, we have unprecedented clinical dominance in the metabolic space. Second, an incredibly aggressive physical manufacturing scale-up. And third, a highly undervalued secondary clinical pipeline. For those viewers who might just be getting familiar with the company, let me break down their business model for you. Think of Eli Lilly as the premier software developer for the human body. They don't just treat basic surface-level symptoms. They essentially engineer complex biological code in the form of advanced medicines to rewrite how our bodies handle metabolism, fight off difficult-to-treat cancers, and manage chronic pain.
Oh my gosh, a software developer for the human body? That is such a cool, simple analogy.
It perfectly captures their approach to modern medicine. But it is proven by the numbers that a great company doesn't always equal a great stock at any given price point. So today, we are going to strictly interpret the meaning of their financial numbers, totally devoid of emotion, to see if there is actually any margin of safety left here for the rational investor.
Let's take a quick look at our agenda for today's explainer. We'll start with the trillion-dollar question, dig into the Q1 2026 financial results, examine their economic moat, look at the expanding pipeline, model out the bull and bear scenarios, and end with the final valuation verdict. Let's jump right in. Section 1. The trillion-dollar question. To set the stage, we really have to look at the sheer scale of the momentum behind this nearly $1 trillion healthcare titan. Wow, look at that number, 410.3%. That is Eli Lilly's staggering 5-year return, hitting around $1,127 a share recently.
If you look at the data here, the one-year total shareholder return alone is nearly 57%. We must interpret what this specific premium means. This is the kind of explosive momentum that is usually reserved for disruptive tech startups in Silicon Valley, not a 150-year-old pharmaceutical company that once mass-produced the polio vaccine. This immense past performance fundamentally dictates the premium that you are being asked to pay in the market today. When a stock runs up over 410%, it's proven by the numbers that the market is aggressively pricing in future perfection.
So what you just said basically means they literally cannot afford to make a single mistake moving forward.
Exactly. It means the margin for error in their upcoming earnings reports is essentially zero. Any slight miss could trigger a harsh correction. To see if they are actually delivering on these sky-high expectations, we need to strip away the stock chart completely and look directly at their most recent fundamental business performance.
Moving to Section 2, Q1 2026 financial results. So the crucial point is, what exactly is driving this growth, and what do the latest financial statements tell us? Are they actually generating the cold, hard cash to back up a near trillion-dollar valuation, or is it all just forward-looking promises?
This slide brilliantly illustrates the true foundation of their financials. Behind the Q1 2026 headline numbers are thousands of employees in manufacturing clean rooms rapidly scaling up physical production. This is a critical differentiator. In the software industry, scaling to 1 million new users costs almost nothing. You just spin up more servers. But if you look at the biotechnology data, scaling means building massive, billion-dollar physical infrastructure. It requires incredibly sterile clean rooms, complex chemical syntheses, and rigorous government-mandated quality control. The global demand for their metabolic drugs is practically infinite right now. The absolute bottleneck is physical supply.
Wait a minute, doctor. What does all this physical manufacturing stuff have to do with our stock accounts? I thought we were analyzing financials.
It has everything to do with it. Because they are supply constrained, when we look at their revenue line, we are essentially just looking at a scorecard of their manufacturing execution. If they can successfully produce it in those clean rooms, the market will immediately buy it. Their financial growth is directly tied to construction and production yields.
Let me break this down for you with the hard numbers. The rational data shows an absolutely explosive quarter. They achieved 56% revenue growth, hitting $19.799 billion, and non-GAAP earnings per share surged by 156% to $8.55. This performance actually prompted management to raise their full-year revenue guidance by a massive $2 billion. Okay, they're obviously making really good money, so why is the stock price heavily debated by so many institutional investors right now? To answer that, you have to look closely at the relationship between the top line and the bottom line. Revenue grew by 56%, but operating income grew by 141%. It is proven by the numbers that this is a textbook, beautiful example of operating leverage. It means that their massive fixed costs, like those billion-dollar manufacturing plants and baseline administrative expenses, are already fully covered by their baseline sales. Therefore, every incremental dollar of new medicine they sell drops almost purely to the bottom line as operating profit. Furthermore, if you look at the source data, their gross margin sits at an astounding 81.9%. Wow, 81.9%, that's insane. So what you just said basically means that once they cover the cost of the factories, they're just printing pure cash on every new prescription. Precisely. Even though management noted a slight decrease due to realized pricing dynamics, maintaining an 81.9% gross margin in physical chemical manufacturing is absolutely elite compared to industry competitors. This specific level of profitability is exactly why the broader market has been going wild. They aren't just growing top-line sales. They are structurally optimizing to generate massive cash flows.
Let's turn to Section 3, the GLP-1 economic moat.
But any good skeptic has to ask, sure, they are making incredible money right now, but what is the irreplaceable weapon actually protecting this growth from competitors?
In professional investing, we call this an economic moat. Without a robust moat, outsized profits simply attract fierce competition, which eventually drives prices and profit margins right back down to earth. Now, what's really important to interpret about this 2025 revenue breakdown is the extreme reliance on a drug called tirzepatide, which is branded as Mounjaro for diabetes and Zepbound for weight loss. As you can see, it made up a staggering 56% of their entire 2025 revenue. Let's not sugarcoat this. It's proven by the numbers that Eli Lilly is highly concentrated. Over half of their massive revenue base is currently dependent on this single dual GIP and GLP-1 receptor agonist.
Oh my God, over half of the whole company relies on one single medicine? Isn't that incredibly risky?
It is absolutely a double-edged sword. On one hand, tirzepatide is a once-in-a-generation blockbuster drug, and crucially, it is protected by strong patents stretching out toward 2036. That is a formidable, legally enforced moat. On the other hand, from a strict risk management perspective, if anything negative were to happen regarding the safety profile or the pricing power of this specific molecule, 56% of the company's revenue is directly in the crosshairs.
However, the demographic moat is undeniably massive. The data shows a potential target market of up to 120 million people in the US alone for obesity and diabetes treatments. Additionally, this is heavily bolstered by a new US Medicare $50 monthly copay bridge program. Wait a minute, doctor. What does a government Medicare copay program have to do with our stock accounts? Why does that matter to an investor? That is a crucial question. The biggest barrier to these drugs isn't consumer demand. The demand is unprecedented. The barrier is high out-of-pocket costs and navigating complex insurance coverage. By successfully working within the regulatory environment to establish a reliable $50 monthly copay bridge program for eligible Medicare patients, Eli Lilly is systematically destroying the friction of adoption. When you lower the out-of-pocket cost for the end consumer so dramatically, you exponentially increase the total addressable market that can actually afford to initiate and stay on the drug consistently. With 100 to 120 million potential patients in the US alone, capturing even a low single-digit market penetration equates to tens of billions of dollars in recurring, sticky revenue. This isn't a one-time surgical purchase. This is lifelong chronic care management. Furthermore, if you look at the data here regarding their pipeline execution, the recent FDA approval of Fendeo, which is a daily GLP-1 pill with no food or water restrictions, meaningfully expands their access far beyond traditional injectables. This brilliantly illustrates how a mature company deepens its economic moat through relentless technological change. That's too complicated. Could you give a simple analogy? What is the difference between this and the current drugs? Let me break it down simply. Right now, most of these treatments require a patient to inject themselves with a needle. Let's be highly rational here. A significant portion of the general population has a deep, ingrained psychological barrier to injecting themselves, no matter how painless or simple the pen device might be. By successfully converting this complex biological treatment into a simple, daily oral pill, and crucially, one that doesn't require frustrating fasting routines like some earlier oral alternatives, Eli Lilly just unlocked a massive new consumer demographic. They are shifting the treatment paradigm from what feels like a specialized medical procedure into something as routine as taking your daily morning vitamin.
This FDA approval is a monumental milestone. They already dominate the present market with injectables, and this strategic move aggressively secures the future market with a highly accessible, consumer-friendly pill.
Moving right along to Section 4, expanding the pipeline.
But hold on, what happens if this whole weight loss market trend suddenly cools down, or a competitor develops a much cheaper alternative? Do they have anything else in the pipeline to protect us, or are they a one-trick pony?
A true mega-cap pharmaceutical company cannot survive long-term on one trick alone, no matter how lucrative that trick is today. The data actually shows very strong diversification. If you look at the data here, in Q1 2026 alone, Eli Lilly spent a massive $3.5 billion purely on research and development. That represents roughly 18% of their total revenue, being aggressively reinvested straight back into future innovations. They aren't just sitting back on their GLP-1 cash pile. For example, they just received a positive opinion from the European Medicines Agency for their oncology drug, Jaypirca. This is a massive deal. It targets chronic lymphocytic leukemia across all lines of therapy, addressing a devastating disease with over 100,000 global cases diagnosed annually.
Wow, so they are making serious moves in cancer too.
Exactly. Furthermore, their recent acquisition of 4E Therapeutics proves by the numbers that they are making highly strategic bets on non-opioid pain management. This is a critical sector completely desperate for innovation, given the severe global opioid crisis and tightening regulations. They are actively utilizing their massive free cash flow from the metabolic side to buy up promising external pipelines and heavily diversify their total portfolio across oncology, immunology, and neuroscience.
Let's get into the forecasts. Section 5, bull versus bear scenarios. Now that we deeply understand the core business, the moat, and the pipeline, we need to look at what the market is actually pricing into the stock right now. Playing devil's advocate, I have to point out that a PE ratio of 39.42x is a massive, towering premium compared to the industry average of just 14.7x. Aren't we just buying into a massive hype bubble?
Let me break down exactly what this valuation multiple means using the data. A price-to-earnings ratio of 39.42 means that at current market prices, investors are willingly paying almost $40 upfront for every single $1 of Eli Lilly's current earnings. Now, when you see that the broader U.S. pharmaceutical industry is currently trading at less than $15 for that exact same $1 of earnings, it shows a glaring, undeniable divergence in expectations. The market is entirely rational in doing this. It is assigning this massive premium because it firmly believes Eli Lilly's future earnings are going to grow exponentially faster than its slower-moving peers.
So what you just said basically means that the market is betting the house that this hypergrowth continues forever?
Yes, and that exposes the fatal weakness, the core risk of the stock. If Eli Lilly's growth simply slows down from absolutely spectacular to just very good, that PE multiple will contract aggressively. The stock price could literally plummet even if the company remains highly profitable and dominant, simply because that baked-in premium evaporates.
So let's strictly lay out the survival scenarios. The optimistic bull scenario sees fair value at $1,189 or higher. The bear scenario warns of a drop down to the $900 level. And the base case sits somewhere in the middle, assuming strong but eventually normalizing growth rate as the market saturates over the next decade.
Okay, but what actually triggers these different scenarios?
Let's look at the specific preconditions. For the bull case to materialize, the data requires a sustained multi-year 20% revenue growth rate. This entirely hinges on their GLP-1 portfolio continuing to easily outpace peers, successfully expanding insurance coverage, and seamlessly bringing massive new manufacturing facilities online without a single hitch, all while enjoying legally protected patent status through 2036. It's highly optimistic but entirely feasible, given their recent 56% top-line growth. However, the bear case is equally grounded in mathematical reality. The trigger for a sharp slide down to $900 involves aggressive regulatory and political pushback on the high monthly pricing of GLP-1s, sudden new pharmaceutical entrants disrupting their market share, or, most dangerously, unexpected safety headlines emerging from long-term real-world use. If any of those specific risks materialize, you will see rapid multiple contraction. Finally, let's wrap this up in Section 6, the final valuation verdict. To get a true sense of intrinsic value, well beyond just assuming the market is pricing in perfection, we have to look at the actual cash this business is mathematically projected to pull in. If you look at the data here, a discounted cash flow model projects that their free cash flow could jump from roughly $8.6 billion today to a staggering $49.4 billion by 2030. Oh my J, a jump to $49 billion in pure cash? That's a five-fold increase? It is unprecedented, but let's look strictly at how this DCF model works. A
A discounted cash flow analysis estimates what a company is intrinsically worth today by projecting its future cash flows and mathematically discounting them back to their present value, accounting for the time value of money. Wall Street analysts are aggressively extrapolating this operational leverage to hit that $49.4 billion mark in just 6 years. If, and this is a structurally massive if, management executes flawlessly and achieves those projected numbers, the strict math dictates that a fair value is actually around $1,477 per share. That means, mathematically speaking, despite the 400% run-up and the sky-high PE ratio we discussed, the stock could technically still be undervalued by roughly 24% right now. But remember, this entire mathematical model completely shatters if the growth narrative falters even slightly. It is a valuation balanced entirely on the razor's edge of flawless execution.
So, to sum up this entire situation for our viewers, I think we have to look to a famous stock market quote from Warren Buffett that perfectly fits Eli Lilly's situation right now. Price is what you pay, value is what you get. Eli Lilly has clearly built an incredibly wide economic moat driven by utterly game-changing GLP-1 drugs, expanding daily consumer pills like Foundayo, and a deep, well-funded R&D pipeline that's tackling everything from leukemia to non-opioid pain. The financial statements are practically glowing with massive operating leverage and cash flow growth. However, you are paying an absolute historically high premium to participate in this story today. We'll leave you with this final thought to ponder based on your own personal risk tolerance. At a 39.4x PE ratio, are you buying the medicine of tomorrow, or are you just paying for the growth of yesterday? Thank you so much for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our Explainer production. See you next time.